Well, hello, everybody, and welcome to another Southern California housing market update. This is for September 27th, 2022. My name is Stephen Meade with Domicile Real Estate for people who love houses. And I hope that's you if you're watching this, or at least people who care about the housing market, right? And so it's been a busy 2 weeks since we last did a general update, and especially the last few days. It's been quite busy, right? And one of the things I'm reminded by is just how, even when we think we're being really objective, and we always try to be objective on this podcast and try to kind of take the emotions out of it or remove them as much as possible, people tend to be that way. And one of the things that people tend to do is they tend to amplify whatever's happening either at the moment, in the immediate future, or the immediate past. And they tend to amplify that and sort of extrapolate very far out. So there's a famous quote: things are never as good or as bad as they seem. I think that's pretty accurate to describe kind of this little thing that us humans tend to do. And I want to take a look at kind of some of the stats and understand what we're seeing now, what I think we can expect in the next 6 months. So I'm going to start off and tell you right now we're in an extremely volatile period. And I think it's volatile on just about every level. It's volatile because of interest rates. It's volatile because of consumer sentiment. I think the overall economy itself is incredibly volatile at the moment. This notion of, are we going to see a large recession? Is it going to be a deep recession, a long recession, a short, a shallow? And I think people's opinions on that tend to kind of be like the tide, right? Like there's some good news comes out, we feel better about the recession. Some bad news comes out and it's going to be terrible and horrible. And, I want to kind of dissect some of that and show you what we're actually seeing in real stats on the ground, right? Because those are things that we actually have in front of us to kind of go through. So I'm not going to delay on that. I'm going to go ahead and run forward and tell you what we're seeing. Some of the things we're seeing that are a little concerning, but also some of the things we're seeing that might indicate some responses that we're going to see in the future. So the first thing we're looking at here is total active listings. And kind of what we're not seeing in this graph is, I think, what's really interesting. So, our blue line here is under $1 million. That's our more affordable range. And our red line is 1 to 2 million. And this is just number of active listings in Los Angeles and LA County in those ranges. So right now in LA and Orange counties, we have, maybe 7,600 or so active listings on the market. And one of the things that I think is really interesting about that is if you look at this chart, what you see is that it went up and that inventory started dropping. But now that's really leveled out and it's just kind of staying where it is. And that is remarkable. We saw that last year in this 1 to 2 million category, but we were well into kind of the fall inventory decline last year. And it started to look like we were getting that. And then it's fizzled out a little bit. And instead, this is kind of, a very slow decline, slower than last year in inventory. So what I'm curious about is where are we going to end up as our low point this year? Are we going to get down, under 5,000 houses when we head towards the new year? And I don't know, right? But it's something I'm sitting here, I'm watching, I'm kind of interested in that. If I take a look here at our last 14 days, these are new listings that have come on the market. I think this is also interesting, right? I mean, look at how much we are not seeing homes go on the market. And that's kind of an interesting effect that we've talked about. And I'm going to go share for a second because I think this is really important. So we're going to take it aside to talk about this. One of the biggest mistakes that people make when analyzing the housing market is they look at something that happens and their thought process ends there. So for example, they say interest rates went up, demand is going to go down, and that is all they're going to think about. And they're not going to think about that the market is not only dynamic, right? Like everything is moving at once, but it's also very reactive, meaning that when one variable changes, we often see other variables change. And you have to kind of try to chase down several levels of what's happening if you want to get an even remotely accurate picture, right? To only look at the one immediate reaction of something is kind of like a really low resolution picture. It kind of looks like the thing you took a picture of, but it's really blurry and unclear. And you really have to think a little bit deeper about the consequences of some of these things, oftentimes out a few steps. Well, if this happens and it makes this happen, what else does that make happen, which makes that happen? You've kind of got to examine that chain, because sometimes those secondary and tertiary effects could be just as big as the main thing, and they can affect sort of your outcome. And if you're not doing that, you're really missing quite a bit. And so when you look at this, new listings are down, you start to ask yourself why. Why is the level of new listings hitting the market down? Well, one result is, if you are a person who's going to sell your house and buy another one, you might not be able to do that now because interest rates have gone up. So not only have rising interest rates reduced the demand for housing, they also reduce the supply of housing. Another thing that you might be noting is a lot of people have mortgages at a very low interest rate because they refinance. And those people may choose alternate things instead of selling their house. They might choose to rent their home out. They might choose to live in it. They may even choose to let a family member live in it. There's a lot of alternate outcomes that may happen because of that. And so I'm not really surprised to see us kind of hitting a low point on these listings. In fact, the level of new listings coming on the market now, look at where we are on this versus where we were last year. We were, 3,200 coming up every 2 weeks on the market. And right now we are just over 2,000. So that's a pretty big drop in that price category. I think if you look here, even in our 1 to 2 million, this has been sliding downward, right? Noteworthy that is a big effect of this market, is not only are we seeing, not as many buyers, but we're not seeing as many sellers. If we look at our new escrows, this data looks a little steadier, right? It's not quite as reactive looking or moving around quite as much. And that number has just kind of really been on sort of a steady decline. Yes, there have been some downs and then ups, but we're right about where we were in terms of new escrows at around 4th of July, beginning of July, which was, kind of a month that consumers were getting used to things. The market moved so much on interest rates in the last 3 days. That is something that people need to get a bearing on, right? They need to understand what that means. They need to re-examine their options. And it takes time for that to happen. People don't like to go into a market that feels very uncertain. They like equilibrium, which is a term we use a lot. Does the market found an equilibrium? It is not an equilibrium right now. It is finding an equilibrium. And that's a much different scenario. If we look at our absorption rate, though, that's kind of interesting, right? These are not terrible absorption rate numbers, meaning that relationship between how many homes are coming on the market and how many homes are leaving the market because they go into escrow. These numbers remain pretty solid. We've had some interest rate increase in the past year, so I'm curious what's going to happen in the next 2 weeks here. But these are pretty solid numbers. These have not dropped off, and I think that's the reason why you're not seeing people necessarily hitting the panic button at this exact moment in time. And I'm choosing my words really carefully. We've had some pretty big interest rate increases, and if that keeps up and we don't get a chance for people to catch their breath, that might be a different scenario. But I think looking at this tells me that we're seeing these things are moving together to some degree. Fewer buyers and fewer sellers. If we look at our closed prices, this is kind of interesting to me. We see a little bit of a bounce, maybe a small bounce here on our median and our 25th percentile. That's entry level, right? But our luxury segment is flat. And remember, these are 4 to 6 weeks ago. So you're looking at what has already happened in the market. I'm curious to see what the shape of these curves look like. Do we see a sharp movement happen? Here's our still active percent after 14 days. This is sort of another level of competitiveness. You see this rose through the spring, right? But it's really kind of held steady at this point. Higher is less competitive. If you look at our close to list ratio, obviously there's definitely a coming to Jesus moment, if you were, with sellers. And we're now seeing both of our price categories in kind of that 99% range. Historically, by the way, the number is usually between 97, 98. That's sort of the historic normal of closed versus list price, right? So, this isn't some drastic, everybody is writing offers $100,000 under. But what does this tell you? It tells you that, on average, homes are not necessarily getting multiple bids and they're not getting bid over those list prices. And, part of that, right, is an expectation of the sellers. What this says is that the market, on average, thinks homes are worth less than the sellers do. And that's an interesting note because back here, you notice it was the opposite, right? The market thought the homes were worth a lot more than sellers did. They were behind the times. Now things have flipped here, right? And it's now the sellers who are kind of trailing behind where some of the buyers' thoughts are. If you look at our days on market and our 1 to 2 million, you see these numbers rose up precipitously and then they kind of hit kind of the high 30s. Under 1 million is heading towards 40 days. I think this is starting to flatten out and it's trying to find an equilibrium. If you look at the three-way graph, I want to take a couple minutes to talk about some things that are happening and that initial comment about what are the secondary and tertiary effects. So just a reminder for everyone who has not seen this or not heard me explain this, what we did here is we basically zeroed out everything to June 2018. So we kind of zeroed out where are these, and then we looked at how these numbers grew over time. So our blue line, the payment index, this is the total payment on a median priced home, right? So this is affected by both home prices and by interest rates. Our CPI index, this is the CPIU without any seasonal adjustment. And what we are looking at here is how is inflation? How does this compare to inflation? And then our yellow line is our single family home rental index. And so what we can do is we can track how these have changed since 2018. And you look all through 2021, through a good, going into 2022, before the rates went up, these were all very similar. Then that payment number kind of went out of control, right? This is rates going up, but something interesting happened. And that was, look at what happened to our rental index. It trailed, but it also ended up jumping. And isn't that funny, right? When you see a gap like this, when you see these things growing together, right, there's a relationship between how much it costs to rent and how much it costs to buy. And when you see this gap develop, what that means is relative to renting, owning has suddenly got more expensive. But the rents ended up jumping up to sort of narrow that gap. And we were playing in this range for a while. But then look what happened. The payments ended up coming down a little bit. Rents came down a little bit, trailing. Now they've bumped again a few weeks and iterations after those rates started bumping up again. So what I'm looking for in here is I'm looking at this differential, because this differential cannot exist for a long period of time. And the reason it can't exist for a long period of time is because it's out of balance. So something's got to give. Either the payment has to drop or the rents have to go up. One of those two things must happen in the long run to sort of resolve the market. And so what I'm waiting to see is, if you say, well, if demand to buy houses goes down, what does that mean for rentals? Well, it's funny you ask that, because the mechanism that seems to happen in many cases, the mechanism that will happen is if a number of buyers move away from buying and they say we're going to rent, and the number of homes available for rent has not gone up precipitously, what happens to that rental market? It gets more competitive, and you see those rents jump up like this and even crest at one point here, again, shortly after the peak. That's not an accident. These markets are symbiotic and related. So when we talk about the housing market, the for sale and the for rent market really are part of the same system. They are not these separate entities that exist out there. And so you have to understand that effects in one of these will have some effects in the other, or you're really missing half the plot of this. Now let's go to the prevailing mortgage rate. So we take this from a number that Freddie Mac compiles on a weekly basis. So the latest version is actually from last week. It was at 6%. This number is higher as of today, right? A typical conforming loan with good down payment is towards the mid sixes at this point. This graph isn't perfect, but we kind of just want to illustrate what's driving this payment index. Now, mind you, we still are not matching the peak payment, which was back here in the end of June. That was kind of our peak payment, but we're well on our way. So the real question that I want to ask is, what happens from here? And what I think happens from here is that there's a lot of factors that are affecting interest rates right now. And probably the biggest one is two things are going on in our market. We're having massive stock sell-offs, and simultaneously we're having bond market sell-offs. That doesn't usually happen, right? Usually the money flows from one place to the other. So people will not be happy with stocks and they'll put the money in bonds, right? Or they'll not be happy with bonds and they'll put the money into stocks. When you see both of these markets fall out, typically that's a fear response. That's people saying what they'd really like to do is just have cash and not have money in either of those things at the moment. And I think a lot of this hinges on, do we think that the Fed's rate hikes are working? And by working, I mean that they will drastically reduce and stop inflation in its tracks. And then the second question is, how bad are they going to have to tank the economy to make that happen? Is that going to happen really soon, or is that going to take a while? And that affects how bond investors think about the future of interest rates, right? If they think inflation is here to stick around, those mortgage rates move up, right? Because it's a weird scenario to have a mortgage rate that is cheaper than inflation for very long. We enjoyed that for a few months. That's not a situation that can exist indefinitely, really. So, because it basically means you make money by borrowing because the rate you're paying back is less than the rate of inflation. So understand that for a long-term future with lower interest rates, you need to have lower inflation. That is a prerequisite to low interest rates in the long run. So, a lot of this stuff hinges on some of this macroeconomic data. And, I don't think they really want to tell you this, but frankly, the Fed's guessing to some degree. They're guesstimating and then waiting to see the results of that. And sometimes those results are even delayed by a month. So you make a decision and you don't immediately see the reaction in some of these macroeconomic indicators. So that's kind of where we're at, right? Is that, we're in this situation where there's a lot of uncertainty flowing around. There's a lot of instability in the market. And I think that makes both buyers and sellers scared, right? If you're a seller and you were thinking about listing your home and you don't have to, maybe you're not going to right now. And if you're a buyer, you're starting to think, is now the right time? And I think those are kind of natural questions to ask. I think one of the problems that you have if you're a buyer is, if you're a buyer in the market, what are you looking for, right? You would like low prices, low interest rates, and tons of selection on houses. Those are probably the three things as a buyer you would like. And a market where you get all three does not really exist. So, I think maybe a few months, maybe a month ago, what you had was higher interest rates, high prices, but lots of selection, right? So you got one of those things. And I think that's the tough part. So I think if you're a buyer and you think you wait, well, maybe you even get a little bit of relief on prices, but you don't get relief on interest rates, and inventory dries up. So you don't have that either. So you've got slightly lower prices and bad interest, higher interest rates and less selection. So I think as a buyer, people are looking for that golden situation where they get all three things at once. And unfortunately, those scenarios are rare and very short-lived when they exist. So there are situations where you can get a great deal in a house that you're not enthused with. um, or you can be paying a higher interest rate than you'd like on a house that you really want. So I think you have to kind of evaluate these compromises and make a choice that works for you. Anyhow, thank you so much for watching. We love doing these videos. We love questions, comments. We run a real estate brokerage here in Southern California in Orange and LA counties. So if you are looking to buy or sell a house, that's what we're here to do, to help you. Definitely reach out to us. We'd love to chat. Don't forget to like, subscribe, and hit that notification bell. And we will see you again real soon.